Hello future CS, welcome back to my channel again, your one-stop guide for everything related to CA exams. So today we'll be solving the case scenario 14 from the case scenario booklet for CA final FR. So if you are new here, I am Pooja, a chartered accountant. I have an experience of working for Ernst & Young and KPMG, and I help CA aspirants like you succeed with practical tips, strategies, and support. So, I have created a separate playlist as solving MCQs from Case Scenario Booklet FR. There, I will be adding all the videos relating to solving MCQs from Case Scenario Booklet for CA Final FR. The link to that playlist is added in the description below. You can watch the videos from there. Also, guys, if you are new to my channel, I request you all to subscribe and hit the bell icon below so that you can get notified whenever I post new videos. So, guys, when you visit my channel in the playlist section, you can see there is a separate playlist for CA final exam. And there is also a playlist for CA final auditing, CA final AFM, and also there is a playlist for this case scenario booklet where I'll be adding more videos by solving the case scenario questions. There is also a playlist as CAGPT for students. In this I have made some videos demonstrating different techniques in which you can use CAGPT while preparing for your CA exams. So please visit my channel and you can watch all of these videos. So first let's read out this case scenario. FA Limited is a company which manufactures aircraft parts and engines and sells them to large MNCs like Boeing and Airbus Industries. Following are the details of some of the transactions entered into by the company. Transaction number 1. On 1st April 2022, the company began the construction of a new production line in its aircraft parts manufacturing shed. So following are the costs relating to the production line. So these are the details and the amount is in lakhs. Cost of basic materials, list price is rupees 12.5 lakhs less 20% trade discount. Hence the amount is 10 lakh. Recoverable goods and service tax incurred but not included in the purchase cost, rupees 1 lakh. Employment cost of the construction staff for 3 months till 30th June 2022, rupees 1.20 lakhs. Other overheads directly related to the construction, 0.90 lakhs. Payment to external advisors relating to the construction, 0.50 lakhs. Expected dismantling and restoration cost, rupees 2 lakh. The production line took 2 months to make ready for use and was brought into use on 31st May 2022. The other overheads were incurred during the 2 months period ended on 31st May 2022. They included an abnormal cost of rupees 0.3 lakhs caused by a major electrical fault. The production line is expected to have a useful economic life of 8 years. After 8 years, FA Limited is legally required to dismantle the plant in a specified manner and restore its location to an acceptable standard. The amount of rupees 2 lakhs included in the cost estimates is the amount that is expected to be incurred at the end of the useful life of the production line. The appropriate discount rate is 5%. The present value of rupees 1 payable in 8 years at a discount rate of 5% is approximately rupees 0.68. 4 years after being brought into use, the production line will require a major overhaul to ensure that it generates economic benefits for the second half of its useful life. The estimated cost of the overhaul at the current prices is rupees 3 lakhs. No impairment of the plant had occurred by 31st March 2023. So now let's see the MCQs that are relating to this transaction. So MCQ number 1, 4 and 5 are related to this transaction. So let's have a look at it one by one. MCQ number 1. Which of the following items needs to be capitalized in determining the cost of production line? Option A. Abnormal cost of rupees 0.3 lakhs. Option B. Recoverable GST of rupees 1 lakhs. Option C. Initial estimate of the cost of dismantling and removing the item and restoration of site of rupees 2 lakhs. Or option D. Initial estimate of the cost of dismantling and removing the item and restoration of site of rupees 1.36 lakhs. So the Ind AS applicable here is Ind AS 16, property, plant and equipment. So as per Ind AS 16, while determining the cost of an item of PPE, it prescribes the following components to be capitalized as per para 16 of Ind AS 16. So let's see what are those components. The cost of an item of PPE comprises of the following: its purchase price, including import duties and non-refundable purchase taxes after deducting trade discount and rebates. Any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management, and initial estimate of the cost of dismantling and removing the item and restoring the site. The obligation for which the entity incurs either when the item is acquired or as a consequence of having used the item during the particular period. So these items will be included in the cost of the PP. Now in the MCQ question, there are 4 options given. So we need to evaluate each of them and find out which one needs to be capitalized in determining the cost of production line. So let's evaluate each option. So the first option, abnormal cost of rupees 0.3 lakhs. So as per para 22 of Ind AS 16, it specifically states the cost of abnormal amounts of wasted material, labor or other resources incurred in the construction of an asset is not capitalized. Therefore, in this case, this abnormal cost cannot be capitalized. It has to be expensed in the P&L. Hence, this is not to be capitalized. Now, we will see the next option. That is the recoverable GST of rupees 1 lakh. So, para 16A of this Ind AS 16 states only non-refundable taxes can be included in the cost. Since GST is recoverable, it is not a cost to the entity and hence it must be excluded from capitalization. Hence, this is also not to be capitalized. Now, option C, initial estimate of dismantling cost rupees 2 lakh. So, although the estimate of rupees 2 lakh is relevant, we need to capitalize its present value, not the full future amount. Because as per para 18 and appendix A, the amount to be included in the cost of the asset is the present value of the expected future obligation. So now let's see the computation of present value. So the rupees 2 lakh is expected to be incurred after 8 years and discount rate is 5%, which is approximately equal to 0.68. This is given in the question itself. That is the present value of rupees 1 payable in 8 years at a discount rate of 5% is approximately rupees 0.68. So the amount to be capitalized is rupees 2 lakh into 0.68, which is equal to 1.36 lakh. Hence the full 2 lakh rupees cannot be capitalized. Now let's evaluate the option number D. Initial estimate of dismantling cost of rupees 1.36 lakhs. So this is the present value of the obligation that we calculated above. That is rupees 2 lakhs into 0.68, which is equal to rupees 1.36 lakh. So as per para 16C and para 18, this amount should be added to the cost of the PP at initial recognition. Hence the final conclusion is only option D complies with Ind AS 16, making it the correct item to be capitalized. Therefore, the correct option is option D. Initial estimate of the cost of dismantling and removing the item and restoration of site of rupees 1.36 lakhs. This has to be capitalized in determining the cost of the production line. Now let's see the MCQ number 4. Compute the total amount to be charged to the statement of profit and loss with respect to production line for the year ending 31st March 2023 and the balance of provision for dismantling cost carried to balance sheet. Option A, rupees 1.70 lakhs and rupees 1.36 lakhs. Option B, rupees 1.42 lakhs and rupees 1.70 lakhs. Option C, rupees 1.76 lakhs and rupees 1.42 lakhs. Or option D, rupees 1.42 lakhs and rupees 1.76 lakhs. The Ind AS applicable here are Ind AS 16, property, plant and equipment, and Ind AS 37, provisions, contingent liability and contingent asset. So in order to solve this question, first we will have to compute the total capitalized cost. So which is computed as follows. Basic material. This is rupees 10 lakh as given in the question. Employment cost. So in the question, the employment cost is 1.2 lakh. This is for 3 months. So we'll have to compute for 2 months. So 1.2 into 2 divided by 3. We will get 0.80 lakhs. Then the normal overheads, 0.60 lakhs. So the normal overheads of rupees 60 lakhs are derived from the total other overheads directly related to construction of rupees 90 lakh after removing the abnormal cost as required by the Ind AS 16. Because the other overheads directly related to construction is rupees 0.90 lakhs. This includes abnormal cost of rupees 0.30 lakh, which is due to major electrical fault. So according to Ind AS 16, only those costs that are directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management should be capitalized. Hence the abnormal cost, like those due to errors, accident, as in this case, abnormal cost due to electrical fault, this must be expensed to the P&L account. Hence, from the overhead cost of 0.90, we will deduct 0.3 and hence we arrive at this normal overheads of 0.60. And then the external advisors, this is 0.50. And then the present value of dismantling obligation. This we had computed in the question number 1. That is rupees 2 lakh into 0.68. That is 1.36 lakh. So the total capitalized cost is 13.26. So the total asset to be capitalized is rupees 13.26. Major overall component. This has a separate useful life of 4 years. That is rupees 3 lakh. and the remaining portion has 8 years useful life. So the remaining portion is rupees 13.26 minus rupees 3 lakh, which is equal to rupees 10.26 lakhs. So part A, total amount to be charged to the statement of profit and loss. So as per Ind AS 16 PPE and as per Ind AS 37 provisions. So following is the calculation. So major overall component rupees 3 lakh. So the useful life of this is 4 years and depreciation is for 10 months. That is from June 2022 to March 2023. So here we have the calculation 3 lakh divided by 4 years into 10 by 12, which is equal to rupees 0.63 lakhs. And then the remaining production line rupees 10.26 lakh. The useful life of this is 8 years and we'll have to compute depreciation for 10 months. So 10.26 into 1 by 8 into 10 by 12, which is equal to 1.07 lakh. So total depreciation to be charged to P&L is 1.70 lakhs. Now we will also have to take into account the finance cost, that is unwinding of discount. The initial present value of dismantling cost rupees 1.36 lakhs, discount rate 5%. Time is 10 months. Hence the following is the calculation. 1.36 lakh into 5% into 10 by 12, which is equal to 0.0567, which we have rounded off to rupees 0.06 lakhs. Hence, as per para 60 of Ind AS 37, the finance cost is charged to the P&L. So following will be the total depreciation now. So depreciation as we computed in the previous slide 1.70 lakh plus the finance cost 0.06. Hence the total depreciation to be charged to P&L is 1.76 lakhs. So now let's see part B, provision for dismantling cost to be carried to the balance sheet. So initial provision, that is the present value which we computed in question number 1, rupees 1.36 lakh. Add the finance cost as we computed in the previous slide, 0.06 lakhs. Hence the closing provision carried in the balance sheet is rupees 1.42 lakhs. So this has to be shown under non-current liabilities as per Ind AS 37. So following is the summary. Amount to be charged to P&L, depreciation plus the finance cost rupees 1.76 lakhs and provision to be carried in the balance sheet rupees 1.42 lakhs. Hence the correct option here is option C, 1.76 lakhs and rupees 1.42 lakhs. Now we'll see the MCQ number 5. Compute the cost of the production line to be capitalized initially on 31st May 2022. Option A, rupees 13.26 lakhs. Option B, rupees 14.60 lakhs. Option C, rupees 13.96 lakhs. Or option D, rupees 15.76 lakhs. So the Ind AS applicable here is Ind AS 16, property, plant and equipment. So as per para 16 of Ind AS 16, the cost of an item of PPE comprises of the following. So this we have already discussed in the question number 1 itself. Purchase price including import duties and non-refundable taxes, net of trade discount and rebate. Then costs directly attributable to bringing the assets to the location and condition necessary for its intended use. And then the initial estimate of dismantling and restoration cost at present value as per para 16C. Now let's see the computation of the initial capitalized cost of the production line. Actually, this is the same computation that we just now did while solving the solution number 4. So let's see the detailed calculation. So purchase cost of basic materials less 20% trade discount, rupees 10 lakh. Then recoverable GST. This is not to be capitalized because this is refundable. Then employment cost for 2 months, just as we computed 0.80 lakhs. Then other overheads. This will be only the normal directly attributable overheads. So 0.90 lakh minus abnormal cost of rupees 0.30 lakh, which is 0.60 lakh. Then payment to external advisors, rupees 0.50 lakh. Then dismantling and restoration cost at the present value, that is rupees 2 lakh into 0.68. So rupees 1.36 lakh. Hence the total capitalized cost is rupees 13.26 lakhs. Hence the correct option here is option A, rupees 13.26 lakhs. Now let's read out the transaction number 2. During the year ended 31st March 2023, FA Limited provided a consultancy services to a customer regarding the installation of new production system related to aircraft parts. The system has caused the customer considerable problems. So the customer has taken legal action against the company for the loss of profit that has arisen as a result of the problems with the system. The customer has claimed damages to the tune of rupees 1.6 lakhs. The legal department of FA Limited considers that there is a 25% chance the claim can be successfully defended. The legal department further stated that they are reasonably confident the company is covered by insurance against these type of loss. The accountant feels nothing needs to be provided for this claim as the company is suitably covered against any possible losses. So let's see the MCQ related to this. So actually MCQ number 3 is related to this transaction. MCQ number 3. What accounting treatment should be done in FA Limited's books for the year ending 31st March 2023, as the customer has taken legal action against the company on the loss of profits that has arisen as a result of the problem with the system? Option A. Nothing needs to be provided for claim instituted by the customer as the company is suitably covered against any possible losses. Option B. Provision of rupees 1.6 lakhs should be recognized with the corresponding charge to P&L. Option C. Provision of rupees 0.4 lakh as per best possible outcome should be recognized with the corresponding charge to P&L. Or option D. Contingent liability would be disclosed in the 31st March 2023 financial statements. Charge to P&L, if any, would be recognized in the period when the claim is settled. So the Ind AS applicable here is Ind AS 37. Provisions, contingent liabilities and contingent assets. So let's see some key facts from the case. FA Limited provided consultancy service, but the customer faced some issues and the customer took legal action. The claim amount is rupees 1.6 lakh for loss of profits. The legal department of FA Limited estimates only a 25% chance of defending the claim successfully. The company believes it's covered by insurance. Hence, the accountant suggests no provision is needed due to the insurance. So now we will have to do a step-by-step analysis by applying the provisions of Ind AS 37. So first we will have to see whether there is a present obligation as a result of past event. Then we will have to see whether the outflow of economic benefits is probable. And we'll also have to see if the amount can be reliably estimated. If these three conditions are satisfied, then the provision must be recognized. So let's do analysis step by step. So is there a present obligation as a result of a past event? So the answer to this is yes, because the customer has already initiated legal action for loss caused by FA Limited service. This constitutes a present obligation. Next question. Is the outflow of economic benefits probable? Yes, 75% of losing the case, because it is mentioned in the question only 25% chance of success is there. That means there is 75% chance of losing. This means outflow is probable. So as per para 14b of Ind AS 37, provision is required when probable outflow of resource is expected. Now let's see the third question. Can the amount be reliably measured? Yes, the claim for rupees 1.6 lakh. So the customer has already told this. So the reliable estimate exists. Hence the conclusion as per para 14 of Ind AS 37, since all the three conditions are satisfied, the provision must be recognized. Hence the final accounting treatment will be as follows. Provision of rupees 1.6 lakh in FA Limited's books. So debit profit or loss and credit provision for legal claim. And also recognize the insurance reimbursement separately only if it is virtually certain. So the correct option in this case is option B. Provision of rupees 1.6 lakh should be recognized with a corresponding charge to P&L. Now let's read out the transaction number 3. FA Limited has an associate company, Flynet Limited. Following are the information of Flynet Limited for the year ended 31st March 2023. Following are the particulars and amount is in lakhs. Net income after taxes rupees 120 lakhs. Decrease in accounts receivable rupees 20 lakh. Depreciation rupees 25 lakh. Increase in inventory rupees 10 lakh. Increase in account payable rupees 7 lakh. Decrease in wages payable rupees 5 lakh. Tax charge for the year, that is deferred tax liability, rupees 15 lakh, and profit from sale of land rupees 2 lakh. So let's see the MCQ relating to this transaction. So in this case scenario, MCQ number 2 relates to this transaction. MCQ number 2, calculate the company's associate Flynet Limited's cash flow from operations. Option A, rupees 158 lakhs. Option B, rupees 170 lakhs. Option C, rupees 174 lakhs. Or option D, none of the above. So the Ind AS applicable here is Ind AS 7. Statement of cash flows, indirect method. So under Ind AS 7, when preparing the cash flow from operations using indirect method, we have to begin with a net profit after tax and adjust the following amounts. First is the non-cash items. For example, depreciation, deferred tax, etc. Then the non-operating items. Example, profit or loss on sale of assets. And then changes in the working capital, that is changes in the current assets and current liabilities. So now let's see the cash flow from operation of Flynet Limited using the indirect method. So net income after taxes as given in the question 120 lakhs. Then we'll be adjusting the depreciation and deferred tax as this is non-cash item. So add depreciation rupees 25 lakh and then we have added the deferred tax charge rupees 15 lakhs. And then we'll be adjusting the non-operating items, that is profit from sale of land. So the adjusted subtotal is 158 lakh. And then we'll be accounting for the changes in the working capital, that is current assets and current liability. So we'll be adding the decrease in account receivable rupees 20 lakhs less increase in inventory rupees 10 lakh. Then add increase in accounts payable rupees 7 lakh and less decrease in wages payable rupees 5 lakh. Hence the final cash flow from operation is rupees 170 lakhs. So the correct option is option B, rupees 170 lakhs. So that's it guys. In the today's video we solved all the MCQs relating to case scenario 14. If you found this video informative and helpful, please like the video and also share it with your study group. And if you are new to my channel, please subscribe for more exam related tips, strategies and guidance. All the best for your preparations and I will see you all in the next video.